So when we look at the break even, and this is at expiration, this is where you see the drawback of buying the call. What is my expiration break even if I buy a 50 strike call for $3? If I buy a 50 strike call for $3, what's my break even? My expiration break even is 53. I need the stock to go up. I need the stock to rise $3 to pay for my call option, to at least recoup my cost. Do you see how that's a drawback or a disadvantage when compared to long stock? Yes. So remember, when you buy an option, here's the way I articulate it. When I buy a call, I need the stock to rise far enough, fast enough to profit. When I buy a stock, time and magnitude don't matter. So when I buy a stock, I need the stock to rise, period, to profit. There's no far enough or fast enough, right? There's no far enough or fast enough. So Maria, when you buy a put, we usually just say you're long a put, and when people say naked put, usually they mean you're selling. Okay, but technically you could say you're long a naked put if you wanted to. Okay? Now, so here's a big drawback is the break even. We need the stock to rise far enough, fast enough. Okay, another drawback is, time decay is an issue. And if implied volatility drops because you're negative vega or you're positive vega, that could hurt as well. That could hurt as well. Okay, so what's the challenge with buying call options as the way of going bullish? Well, hey, it's a lower probability bet, right? So because, if we go back to this line right here, because we need the stock to rise far enough, fast enough, it's a lower probability bet. Okay, so because of this, buying calls is a lower probability bet than buying stock. Even though it's cheaper, even though it's more leverage, it's a lower probability because you need a bigger move in the stock to profit. Everybody square? We got to have that as square one before I move into bull call spreads. Okay, that's the drawback. And for you guys that have bought calls, you've seen that, right? So when you buy a call, the stock goes up, but it doesn't go up fast enough, so you lose money due to time decay, right? You buy a call, and it goes up, but it doesn't go up far enough, so you'll lose money overall, right? I mean, on paper, it seems like, yeah, you're bullish, just buy calls, it's great. It's easy, you make money. But it's not, because at least it's not easier than making money buying stock. It's actually harder because the stock has to move more. Okay, so that's the difficulty with profiting with a long call. Okay, so the bull call spread, we're going to try to build a better mousetrap. We're going to try to improve just the straight naked call. We're going to try to make it a little bit better. We're going to tinker, modify the strategy just a touch, and try to improve upon those disadvantages. Okay. All right. So, and then later, Ed, remind me again, and I'll talk about naked puts and versus long calls. Okay. One other thing, actually, I want to add real quick is a risk graph. Okay. So let me see here. All right. So this is a risk graph of long stock. Okay, so we have long stock, right? So this is unlimited reward and really unlimited risk until you hit 0, right? And then a long call is a hockey stick, right? So to visually show people, hey, long call maybe a better idea than a long stock. You say, hey, you still got the upside, but you don't have as much downside. Right? It's a good way of visually showing somebody that concept. I say, oh, okay, I get it. I mean, you have limited risk down here versus all this risk. Okay. So what's the what's the bull call spread going to do? How's that going to differ? Well, let me tell you. Okay. So I have to put long call here just so we're square. Okay. So what about, I would call this a long call spread, aka a long call vertical spread, aka a bull call spread. Okay. Now, on behalf of all option teachers, I apologize for the fact that we've made 10 different ways of saying the same thing. Okay. But don't blame the messenger, okay? I didn't make all this up. Had I made all this up, it would have been far simpler. That I tell you, okay? But sometimes, it is what it is. So look, there's about 3 or 4 different ways of referring to this. Some people call it a bull call spread. Some people say you're long a call vertical spread. Some people say it's just a long call spread. And quite frankly, I could also say I'm going to buy a call vertical. Okay? Oh yeah, there you go, Ethan. AKA long call vertical debit spread. That's another way of saying it. Okay? See, we're just trying to scare the children away so they'll give us their money to invest, right? That's what Wall Street is. It builds these walls of terminology. It says, don't come in here, too scary in here unless you know the term and the lingo, right? Okay, so what's the structure? Well, you're gonna buy a call option, right? You're gonna start the same way. So this guy bought a 50 strike call for $3. And I need to be more specific. Let's say he bought a November 50 strike call option. Okay, we're gonna start out the same way. Buy a November 50 strike call option for $3, right? Buy a November 50 strike call option for $3. Starting the same. What's the difference? Well, now we're going to sell something against it. Same month, higher strike. Let's say we get $1.50. Okay, now let's think about what that does to the cost. I know I have some mathematicians in here, so you guys, you may not even need a calculator for this one. You may not even need a calculator. You buy something for $3 and then you receive $1.50. How much is it going to cost overall? $3 comes into your pocket and then $1.50 goes out. Okay, so $1.50, right? Is that less expensive? Is that less expensive than just buying a call option? Yep, it's less expensive. Okay, and guess what? That's also your max risk, by the way. $1.50. Okay, so we have less risk. Is that a benefit? Is that an advantage? You bet.